Imagine you put $10,000 into the S&P 500, a fund that owns 500 of America's biggest companies. Then a crash hits. The value drops almost in half. You panic and sell. How much money did you lose? And how much did you throw away by not waiting? The answer will shock you, because selling versus holding is not just a few bucks. It can mean the difference between retiring comfortably and working 10 extra years.
Market crashes are scary. The news tells you everything is falling apart. Your stomach drops when you see your account balance cut in half. The urge to sell everything, to just make it stop, is almost impossible to resist. But here's the thing. Every single person who sold at the bottom of the 2008 crash locked in their losses forever. And every person who held on got their money back, and then some. This video is going to show you exactly what happens to your money when you panic sell. We are going to look at real numbers from real crashes. We are going to explain why your brain tricks you into making the worst decision at the worst moment. And we are going to give you 3 simple tools that professional investors use to stay calm when the market is falling. By the end, you will have a plan. Not a vague plan, a real one that you can use for the rest of your investing life.
Let's start with the history, because crashes are not rare events. They happen all the time. In fact, the S&P 500, that is the fund that tracks 500 big American companies, has crashed at least 6 major times since 1980. The dot-com crash started in the year 2000. Tech companies had gotten wildly overpriced. When reality hit, the S&P 500 fell 49%, nearly half your money gone. If you had $10,000, it dropped to about $5,100. Then came the 2008 financial crisis. Banks made terrible loans. The whole system nearly collapsed. The S&P 500 fell 57%. $10,000 became $4,300. And every single time, the market came back. Not in days, not in weeks. It took years. But it always came back. And not just back to where it started. It went higher, way higher. Here is the key insight. A crash is not a permanent loss. It is a temporary drop. The only way it becomes permanent is if you sell. Because if you sell at the bottom, you never ride the recovery back up.
The COVID-19 crash of 2020 is the most dramatic example in recent memory. In February of 2020, the S&P 500 was at all-time highs. Then the world shut down. In just 33 days, the market fell 34%. That is the fastest crash in American history. $10,000 became $6,600 in 1 month. The news was terrifying. Nobody knew how long the pandemic would last. Millions of people sold. They did not want to watch their savings disappear. But here is what happened next. The market recovered completely in just 5 months. By August 2020, it was back to where it started, and then it kept going. By the end of 2020, the S&P 500 was up 18% for the year. Those who sold in March 2020 locked in a 34% loss. Those who held ended the year with gains.
Let's do the actual math, not percentages, real dollars. Say you invested $10,000 in an S&P 500 index fund. That is a fund you can buy through any brokerage app. During the 2008 crash, your $10,000 dropped to $4,300. You are watching 57% of your money disappear. Most people sold right here, and their $4,300 stayed $4,300 forever. But what if you held on? 5 years after the crash, your original $10,000 had grown to $16,400. 10 years later, it was $25,000. So the person who panicked and sold ended up with $4,300. The person who held ended up with $25,000. The difference? Over $20,000 from just one decision made in one scary moment. Think about what $20,000 means. That is a year of college tuition. That is a down payment on a car. That is years of groceries for your family. That is the real cost of panic selling. Not a percentage, real money. That was yours until fear took it away.
Now, you know what panic selling costs. The numbers are brutal, but knowing the numbers is not enough, because when a crash actually happens, you will not be thinking in spreadsheets. You will be thinking in fear. That is the real problem. Not a lack of information, a flood of emotion. So let me ask you something. Have you ever made a good decision in a moment of pure panic? When you are scared, your brain does not work the same way. It switches into survival mode, and survival mode is great for running from a bear. It is terrible for investing.
Buy low, sell high. You have probably heard that phrase 100 times. It sounds obvious. Buy when prices are cheap, sell when prices are high. But here is the brutal truth. Almost nobody actually does this. Because when prices are low, it is because everyone is scared. And when everyone is scared, your brain tells you to run, not to buy. The people who actually buy low are the ones who understand why everyone else is running away. Let's look at why that is so hard.
Scientists have studied how people make money decisions for decades, and they found something wild. Losing money hurts twice as much as winning money feels good. Not a little more, twice as much. If you gain $100, you feel pretty happy. But if you lose $100, you feel twice as bad. The math is equal. The emotional experience is not. This is called loss aversion. It is built into your brain. It helped your ancestors survive. Do not risk your food supply. But in investing, it works against you. When the market drops 10%, your brain treats it like a crisis, even though 10% drops happen every single year. The S&P 500 has had double-digit drops in more than 30 of the last 70 years. That is completely normal. Your brain does not see normal. It sees danger. And then there is herd mentality. When everyone around you is selling, your neighbor, the news anchor, selling must be the right move, right? Wrong. When everyone sells at once, they drive prices down further, and the investors who hold are left to buy shares at a massive discount.
There is one more mental trap. It is called recency bias. Here is how it works. When something bad just happened, your brain assumes it will keep happening. After a market crash, your brain says, this is the new normal. Prices are going to keep falling. It is never coming back. But history says the opposite. Every single major crash in American history has eventually been followed by a full recovery. Every one. The 2000 dot-com crash took 7 years to fully recover. The 2008 crash took about 5 years. The COVID crash took 5 months. See the pattern? Each recovery has been faster than the last because the American economy keeps growing. Companies keep innovating. People keep buying things. Recency bias is the mistake of thinking the last few months are a preview of the next 50 years. They are not. They are just noise. Zoom out. Look at the 100-year chart. It points in one direction, up.
So now you know the traps. Loss aversion makes losses hurt twice as much as gains feel good. Herd mentality makes you follow the crowd right off the cliff. Recency bias makes you think a bad month means a bad decade. You know all of this. And yet, when the next crash happens, these feelings will come back. They always do. Even professional investors feel them. So the question is not how to eliminate the feeling. The question is how to build a system that removes you from the decision entirely. Because the best investment decisions are the ones you make before the crash, not during it. Here is what that system looks like.
The first tool is called rebalancing. It sounds complicated. It is not. Here's the simple version. Say your plan is to keep 60% of your money in stocks and 40% in bonds. Bonds are basically loans you make to the government or big companies. They are steadier than stocks. When the stock market crashes, your stocks drop in value. Now maybe you have 40% stocks and 60% bonds, the opposite of what you wanted. Rebalancing means you sell some bonds and use that money to buy stocks. You are buying stocks when they are cheap. That is exactly what you want to do. It sounds scary because you are putting more money into something that just fell. But you are not gambling. You are following a plan. You made the plan when you were calm. Now you are just executing it. Think of it like this. Your grocery store puts milk on sale. You buy extra milk. The market on sale is the same idea. Lower prices mean you buy more shares for the same dollar.
This rebalancing strategy sounds like something only rich people do with their financial advisors, but it is not. You can automate the entire thing. Many investment apps like Fidelity, Vanguard, or robo-advisors like Betterment and Wealthfront will rebalance your portfolio automatically. You set your target percentages once. The app handles the rest. No panic, no emotion, no decisions during a crash. The system quietly buys low while everyone else is selling. That is the power of automating your investing.
There is an even simpler strategy.
It is called dollar cost averaging. Big name, simple idea. Here's how it works. You invest the same amount of money every single month, no matter what the market is doing. Say you invest $300 every month. Some months, the market is up. Your $300 buys fewer shares, but the shares you already own are worth more. Some months, the market is down. Your $300 buys more shares at cheaper prices. Over time, you automatically buy more when prices are low and less when prices are high, without thinking about it, without watching the news, without making any decisions at all. This is called dollar cost averaging because you are averaging out your purchase price over time. Think of it like this. You fill your gas tank every week. When gas is cheap, you get more gas for your dollar. When gas is expensive, you get less, but you always fill the tank. You never try to time the gas market. That is exactly what dollar cost averaging does for your investments. Slow, steady, and automatic.
Let's bring this all together. We started with a simple question. What happens if you panic sell during a crash? Now you know the full answer. You lock in your losses. You miss the recovery. You hand over tens of thousands of dollars, real money, because of a decision you made in a moment of fear. The S&P 500 has survived 2 world wars, the Great Depression, the dot-com bust, the 2008 financial collapse, a global pandemic. It has survived all of it, and it has not just survived, it has grown. $10,000 invested in the S&P 500 30 years ago would be worth more than $200,000 today, not because someone timed the market perfectly, because someone held on. You do not need to be brilliant to invest well. You need to be patient. You need a plan that takes emotion out of the equation, and now you have one.
If this video helped you understand why panic selling destroys wealth, hit subscribe. We break down finance and investing every week in plain English, no jargon. And if you want to go deeper, our next video covers index funds from the very beginning, what they are, how to pick one, and how to open your first investment account in under 10 minutes. That video could be the most important 15 minutes of your financial life. Click right there to watch it next.